not really the best of mornings, as was the case last afternoon as well. The fact that we sunk below that 17,200 print as well on the index and sharply lower than that, breaching some very, very key levels. And again, overnight, it's not been smooth at all. In fact, to say the least, it's been quite the roller coaster and quite the rough ride. Financial markets have seen huge and immense amount of volatility. You had the S&P 500 index settling in just marginally lower, but don't go by that. It was a wild swing from the high to the low of the day. The Nasdaq, even though on closing, has managed to eke out a gain for itself, but again, a huge volatility there as well intraday. And the rest of the market as well saw huge moves. Yields as well have plunged. In fact, the US two-year yield is down 47 basis points, and the 10-year yield has lost about 20 basis points, settling around that 3.5% mark. The US dollar index as well, that too has fallen about 0.6%. And the KWB regional bank index, that ended lower by about 7%, again seeing huge intraday swings coming in. So all that we thought could go wrong is actually going wrong.
Aisha, it's a patch of extreme price adjustment. Now, if there is panic in the market about something going wrong in the world, then equity markets by now would have really gone into a selling stampede. I guess every financial market needs to be looked at differently. So let's start with the big one first, which is the drop in yield. Drop in yield will only happen because of two factors. There is no other third factor I can think of. Factor number one, that interest rates have peaked out. If interest rates have peaked out, there are again two underlying factors here. That inflation has peaked out or the US economy is going to break down. That is the reason why yields have come down. I don't know which one is true. But for the moment, global financial markets, at least the US Treasury market, are saying that we are nearing the peak of an interest rate hike. If we are nearing the peak of an interest rate hike, bond yields will come down. The fact that the dollar index, typically which goes higher when there is a issue in the world, is also down, it means that the currency market and the dollar index is indicating that the US economy will slow down and money is moving to gold. That also could be a function of the fact that a safe haven buying is making a comeback. So it's a very complex way in which how financial markets and each instrument has acted and reacted. You've got a surge in Bitcoin, a surge in gold, a drop in bond yields, and a little bit of stability which has come in emerging markets like India and China. So just like one shoe does not fit all, you cannot connect all the dots in a very linear manner. But typically when you see this kind of an extreme volatility on both sides of the trade, and especially in the treasury market, it is bad news, it is not good news. The approach in this kind of a market is, if I may use the English word, don't be a cowboy. If I may use the Hindi word, which is a colloquial to Bombay, don't try to do something which is extraordinary different.
How's that Hindi?
Shivaji is the word. I didn't want to use it.
But anyway, let's just tell you what the Fed's response has been to the SVB fallout. And I'm just going to quickly, get the quote out here and tell you what the Fed commentary has been like, because they're saying right now that we are taking decisive decisions or actions to protect the US economy by strengthening public confidence in our banking system. This step, they say, will ensure that the US banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. So while Fed is, talking the talk, but clearly, investors out there are repricing assets all across. Like you said, the rise in Bitcoin, the move in the precious commodities, and the fall in volatility.
Yeah. So in the light of what's happening in the world, I guess the CPI data, the US CPI data, and the Fed commentary in the Fed meeting next week is of immense importance. In general, the view now seems to be that Fed is not going to be increasing rates. That's a consensus view, and that's the reason why yields have come down. Similarly, will inflation come down in a measured manner? Well, the recent data seems to be telling us completely different. Now, the problem is that what if the CPI print is higher? And what if Fed is not very happy with the inflation print? Then that means they will not increase rates, that they will not cut rates, or they will not hit a pause button. If they don't hit a pause button, then what happens to the underlying ROI in the financial market? So it's not going to be an easy patch, so to speak. If you have to connect India, see, I look at Indian markets differently, and you got to ask yourself that, okay, what has been the general price trend? The general price trend has been that up until now, Nifty has been in some kind of a range, and mid and small cap stocks were tossed around. While there has been a challenge in terms of dealing with volatility in 2023, given what's happened to the Adani stocks and global news flow, you've not seen a proper breakdown in the Nifty. But now you've seen what could be called as a proper technical breakdown in the Nifty. So what do you do in this market? That is the most important thing. Let global cues take their course, because there is no point in trying to preempt and prejudge. You normally buy a patch of bad volatility when prices are very attractive, but I'm afraid they are not. I guess March would be a very difficult month to call, and I think for the market it will take some time to adjust, because Nifty is broken down, FIs are selling, it will take some time to adjust. Since markets are not very cheap, I think that closer to the earnings season you will find some opportunity, but till that time it's better to just watch the market, do your homework,
Stay on the sidelines.
stay on the sidelines. There is no
Wait for the
point in
dust to settle,
there's no
so to
point in, if you're a trader, look, the trend's broken, you go against the mob, which is the bears right now, you're going to get robbed. So don't go against the mob right now.
Don't go against the mob. And just to put that into context, yes, we did witness that acute sell-off in yesterday's trading session. That's how we wrapped up the day, 1.5% lower, and 3 straight days on the trot. But of course, yesterday the selling pressure intensified quite acutely. We were down over about 500 points in total, and yesterday shaved off about 258 odd points. FIIs, as we've been highlighting, they continue to remain net sellers to the tune of about 1,500 crores, for example, in yesterday's trading session. And then critical to monitor what's happening when it comes to banks. It's the Nifty Bank Index that tested the 200 daily moving average, and we're seeing a rout coming in banks across the globe as well, so we're not alone in this. The FII holding, incidentally, is at about 16% versus the average of about 25%. The F&O trend as well, indicating fresh shorts. And also we're monitoring what the global markets are throwing up. The fact that this morning you've got the US futures indicating a bit of a positive start, the SGX Nifty mildly in the green by about 1/3%, Nikunj. So even when we're going by way of levels to watch on the index, it seems that support around the 17,000, 16,800 mark is a bit critical.
Samira is ready. So